I'm Howie Lim. This is Money Hacks by the Business Times.
Every financial advisor is always about future planning. Well, what about present day planning? What if you could actually create the wealth now so that you also have a great future later? And that's the one thing that's missing out there.
Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And today we're getting expert help from Chris Miles, the anti-financial advisor and cash flow expert. He's also the CEO of Money Ripples. Chris, good to speak.
Yeah, same here. Really appreciate to be here.
I want to start with some tried and tested personal finance tips, which we've all heard, like save for the long haul. That can't be bad, right?
Save for the long haul is a fascinating one, right? There's no accountability. If you really think about it, I'm not saying for the person that's saving, but for the person that's giving the advice. Because they always say, just save for the long haul, just keep set it and forget it. And by the way, I used to be a financial advisor over 20 years ago, right? I used to teach the same thing, spend nothing, save everything, save it forever. Hopefully someday you'll have something to live on. Well, here's the problem. If the stock market goes down right before you're going to retire, how long does that long haul become? Because that's what happened to my dad. This is the thing that got me out of financial advising. My dad reached out to me and says, hey, Chris, I want to retire. Are you going to advise me at some point? Now, understand, my dad was a penny pinching saver. He was very disciplined, had no debt. This guy was like the model example of what somebody was supposed to do with their money. The same thing I was teaching as a financial advisor. And he says, Chris, I'm 61 years old. I've literally had heart attacks and strokes. I want to quit. Great. You're debt free. You've saved all your money in your retirement accounts. Here's the deal, Dad. If you want to retire today, you would have to die in about 5 or 6 years because that's when you're going to run out of money. Okay, well, what do I do? I'm like, I don't know. Save more, save longer, save for the long haul. What happened a few years later? Market tanked. He had to literally delay his retirement until his 70s due to health reasons, not because he wanted to, because he just couldn't work anymore. Even to this day, 10 years later, he's trying to stretch every dollar he can because he's burning through it so fast because of rising healthcare costs and things like that. Save for the long term, I don't think that's a bad thing. Every financial advisor is always about future planning. Well, what about present day planning? What if you could actually create the wealth now so that you also have a great future later? And that's the one thing that's missing out there.
What about it takes money to make money? You can't invest yourself into wealth, so it takes money to make money.
There's no doubt money does help to some level, right? Especially when I talk about passive income. It's not passive unless you can literally give your money to somebody else who's doing the work. That being said, it does not take money to make money because let's go back to when you were in high school or in college. Did you have a lot of money then? Now, when you went to get your first job, for example, did you go to your employer and say, listen, if I pay you $50,000, will you give me a $70,000 a year salary? That didn't happen, right? You didn't have to give them money to make money. You had to offer value. And this is the thing most people miss. This is why people make excuses when they don't have money. They say, well, I just don't have money, so I can't make money. That's not true. You have value you can offer, your strengths. What can you do to help solve problems, add value, or serve people in such a way that they want to exchange that money with you? Because whatever you offer as a service or a product or whatever it might be brings more value to them than just having dollars sitting in their pocket. So if you stop asking, how do I make more money, especially when I don't have make money or don't have money to make with, great. Well, then start asking, what can I do? Who can I serve? What problems can I solve for somebody else? How can I create a win-win where I can then earn money? And that is how you make more money. It's always about how dollars follow the value you create for other people. It could be your business. As a financial advisor, I used to think the only way I could win is if somebody else lost. I used to think it was a win-lose transaction, right? In the financial advising world, you make commissions and stuff. Well, I make commissions off of what I sell people. Obviously, that costs them. There's fees coming out of their money. Oh, well, that slows them down. Well, maybe I should minimize my fees so they win more. But that doesn't really work. Just like in business, you're selling something to enrich people's lives. So when I first learned from guys that were millionaires, they said, listen, stop asking about making more money. Money doesn't make money. Value creates money. So focus on how do I give enough people what they want so that you can get what you want. In a way, money is just a natural consequence of the value I've created.
I feel like that's hard to wrap one's head around. Most of us are, as you say, employed. So yeah, we could think about how to add value in our jobs for our employers, but that's about it.
Right when I launched Money Ripples, I had started another company with another partner, but then we broke up. And I had a 2-year non-compete with that partner. So I had to start it brand new. As I was doing that, I remember I was in one particular Facebook group. And a lot of them would keep saying, they said, man, how do I make money from my mission or my passions? You know how you always hear, do what you love and the money will follow. There's so many people that are passionate about what they do, but they're broke, right? There's a lot of broke, passionate people. So that's not the equation. Hey, I've actually got a system that I created that will show you how you can turn your passions into money, essentially your passions into profit. Oh, that'd be great. Lots of likes and comments. Cool. And I just created on the spot. I said, all right, I'm going to charge $50 a person for max of 20 people. Monetize your divine genius. I did it live. I already had the system and stuff. I wasn't like I created it out of thin air. And I recorded it, just like you're recording at this podcast, right? Well, now I created a recording. That's a packaged product that I would then sell for $500 with the workbook and everything else we created. So again, it took $0 for me to do that. You know, it wasn't anything fancy. I just did it with my own time and energy, but I was able to create money with that. So that's the thing. You don't need money to make money. You just got to figure out what problems do people have or what things are people looking for solutions that maybe you can uniquely provide that others can't.
Okay, so I've got one which I bet you don't agree with. Always pay the highest interest rate first. Because everyone says that, right? Pay the highest interest rate first because it'll kill you.
Yeah, you're right. Most people will go for the highest interest rate when it comes to debt. I learned firsthand because although I became financially free in 2006 after I quit being a financial advisor, the thing is, in 2008, we went to a global recession. My brand new business I started with partners was failing. I was like millionaire to welfare, where I was living on government support. And what I realized was this. It wasn't the $1 million plus of debt that I had that was stressful. It was the monthly payments because I had to keep paying that every month. And that was taking money away from me and my family. And so I created my own little system called a Cashflow Index. I don't worry about the interest rate. I mean, it's a concern, but it's not my main concern. My main concern is what's the biggest payment that I can get rid of with the least payment or the least balance. So for example, let's just say you have two $10,000 loans. Maybe one's a credit card, maybe one's a car loan. Let's just say the credit card is $200 a month that I have to pay on that $10,000. Look at the other $10,000 car loan. Let's just say that one's $500 a month. Even if it's lower interest rate, which one creates the most financial stress? The $200 a month payment or the $500 a month payment? It's the $500, right? So if I pay that one off first, what it does is that, especially if you're a business owner, it creates more options. Income can fluctuate. Expenses can fluctuate each month. And so you want to make sure you reduce those expenses as low as you can. So if all I had was $10,000, I would go for the car loan, even if it had the lowest interest rate because it's the highest payment. Because now I've got that $500 freed up. I can take that $500, I can apply it to that $200 a month payment of a credit card and still pay it off in about a year. And there won't be that much interest charged. That's the thing that shocks people. It's not like you pay, thousands of interest on a $10,000 card. They lead you to believe that if you go 30 years of not paying it off, sure. But if you pay it off quickly, you get charged very little interest. But what it does, it creates that flexibility. Financial freedom is not all about how much money you have in the bank, although that helps. It's not even about how much debt you do or do not have. It's literally about how much extra cash do I have each and every month. That cash flow, that profit in your life is what creates real freedom.
When you put it that way, it makes sense, but help us out with some numbers because I still can't quite grasp it.
I take the balance of the loan, I divide it by the minimum monthly payment, and I'll get the index. So in this case, that $10,000 credit card divided by $200 a month is an index of 50. But that $10,000 car loan divided by $500 a month is 20. The lowest one gets paid off first. So I always pay the lowest one first. Once that one's paid off, I go to the next lowest one and I roll it. So just like what people do with interest rates, instead of doing that, roll it to paying off the next lowest cash flow index. And as you start to go up, you'll realize that you essentially pay less money to free up more cash. And that's the important thing.
Okay, still to come, sacred tips questioned and more of Chris's pet peeves with regard to financial advice. Stay with us.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Claressa Monteiro in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Money Hacks from the Business Times.
Welcome back. Chris, let's talk about why they call you the anti-financial advisor. What's the beef you have with them, or what's your issue with the advice they give?
There's a couple of them. One, high risk creates high returns. What's the definition of risk? I'm in the financial industry. The definition of risk is simply chance of loss. What's your chance of losing? What's interesting is when they say a higher chance of losing, higher risk creates higher returns. How did a 90% chance of losing equal a 90% chance of winning? That doesn't equate to 100%. It's 90% chance of losing means you have a 10% chance of winning. The only people that want you to believe that high risk creates high returns are those that want you to take all the risk so they take none. For example, any investment company, they're the ones that teach you high risk create high returns. They tell you they're financial advisors, and they teach it to you. Why? Because they take their guaranteed fees off of you each and every year. They don't take any risk. When you lose money in the stock market, they don't lose money. They were just investing your money, but they're always taking fees whether you make money or not. And that to me is almost criminal. That means even if you say you lost 50% of your money in the stock market, sure, they won't get paid as much, but they still get paid even though they didn't deliver real value for you. I would rather do what banks do. I would rather instead take less risk. I want to get those guaranteed returns. I want cash flow coming in, which is what a company like a financial company does all the time. Banks do it all the time. By the way, if debt were so evil, why do banks have so much debt? Because every time you put $1 into your savings account and they pay you interest, they're in debt to you, aren't they? It's not their money, it's your money, but they're leveraging your money to make more money. So why wouldn't we do the same thing? If we could learn to be better investors and better stewards of our money, we can make more money with it. But here comes to the third lie.
Okay, wait. First lie was high risk creates high return. Second, debt is evil. Third?
The third lie is this: investing equals stock market. I know in the US especially, I hear all the time, the S&P 500, the index is the best, safest investment ever. One, it's not the safest. Two, who's to say that's the best investment ever? They're like, yeah, it's the most diversified. Well, unfortunately, it's not. Not anymore. It used to be, but it's now shifted and changed where almost all that index is just 10 companies. 40% of that index is all 10 companies. The other 490 companies are only the other 60%. If Apple has a hard day or Nvidia has a bad time, you could lose a lot of money even if the rest of the stock market's fine or the rest of America or the economy is fine. I would definitely not gamble and get debt like a bank would to go put in the stock market. In fact, banks do not put money in the stock market with debt. But what they will do with debt is they'll invest in one, real estate, two, business, assuming you have a good business model. Three, maybe they'll do personal loans and stuff, but they'll make sure that there's some sort of ways they can get collateral, or they'll charge you obscene amounts of interest to take on that risk. But for the most part, they love to give you money, lend money and borrow money, or real estate, or things that have real assets behind it, even things like cars or whatnot. They'll want to have an asset behind it.
Oh, fair enough. Then what should we do with our money, especially for the ones of us who really don't know a lot about investing and all that?
I'd rather take my money, invest in one, my own business, because I can control my returns. And then two, I would also invest it in things like real estate where there's real value, tangible value backing it up, especially if I do it in a safe manner. Not the typical real estate that most people do. I'll actually lend my money to real estate investors. I will become the bank for you, but you got to give me that property as collateral. So if you don't pay me, I take that property, which is worth more than the money I lend you. Just like a bank would if they give you a mortgage. I can do the same thing with my money and get paid 10, 12% a year with less risk than the stock market. There's things I can do that's outside of Wall Street, outside of the stock market that people just don't realize because they've always been taught that stocks is the only way to invest. Because why? That's what all the financial institutions and all the financial advisors tell you because that's what they sell you. And that's why I left being a financial advisor. I realized I was part of the lie. Yet, like you said it's tried, it's been tested. It has been tested. yet it hasn't worked.
Is there a cheat sheet or a cheat code we can enter to bypass all the noise and just level up?
Yeah, I say these three things is get lean, get liquid, get out. So get lean means be a wise steward of your money, track your money, not just on a monthly basis or a never basis like most people do, but track it every week. How much is coming in? How much is going out? What are you spending it on? How much money are you making? Could you be making more money? So tracking your money is getting lean. Get rid of things that don't make a difference in your life, a good difference. Prioritize. You're not cheap. It doesn't mean you're not spending money. It just means that you're being responsible with it. Get liquid means don't lock your money up in prison. Most people are told to lock their money up into retirement plans where they can't get to it. They're told, if you try to touch this before a certain age, we slap you with a penalty and then we tax you some more money too on top of it. Rather than locking up there or locking up by trying to pay off your house early, which is a lot of people do. But then, like what happened to me in the last recession, I had equity in a property. It was trapped. I couldn't sell my house fast enough and I watched the real estate values drop. I lost all the equity that I had. I would have been better off in the recession had I had that money in my own pocket, in my hands. That could be in a local bank. That could be in high yield savings accounts. It could be a brokerage account maybe. In the US, I even have people locking that money away in like life insurance where you can access it just like a savings account, but make a higher return than in the bank and it's tax free. Keep that money liquid and in your control. Don't lock it away in those prisons. And then the third thing is then get it out. So once you have that money liquid and you have more than enough for your emergency savings, and then you have money you're saying, now what can I do to create passive income? That's when we get it out to invest in those different areas. And it's really not as hard as people think. The only reason it's hard for people is because you won't find a financial advisor that says, yeah, here's where you're going to find it, because they don't get paid to give you that advice. I can go, like I said, lend my money and make double-digit returns. I have a raw land business that, again, I don't manage it. They do all the work, but I finance it. And that $500,000 that we've put into it has generated almost $13,000 a month. There are so many options that are available outside of Wall Street.
What about some other subtle money leaks, so to speak, that most people completely overlook?
A big money leak I often see is lately has been subscriptions, apps that people are paying for that maybe they only get charged once a year or maybe once a month. That's often because people aren't tracking their money. Another leak I see often is sometimes I see people saving in retirement accounts while having high interest debt. And even though I say ignore the interest rate when it comes to picking which one to pay off first, the truth is still, why would I put my money in a retirement account that I might make 8% in when I'm paying 18% on a credit card? You would be much better off freeing up the cash flow to again give you a benefit today, paying that off versus blocking it away. Even if they say, hey, well, my company's going to match my money, doesn't matter. The match long-term isn't worth it anyways. Selling off things. I see a lot of times people will accumulate things and then just not use it. My mantra is if I'm not going to use it, lose it. That means sell it off, donate it to charity, or some goodwill or something like that. If you donate to charity, by the way, you might get a tax write-off. Why not either sell it, throw it away, or donate it to where you can at least clear out your stuff and get a financial benefit too.
Okay, what's one piece of sacred cow financial advice you now tell people to ignore?
People will say that investing in real estate, for example, is risky. And even in Singapore, it can be. I mean, Australia is another good example. Australia, real estate's horrible. But what most people don't realize, especially outside of the United States, is that you can actually invest in the United States. You can actually invest easier than some of our own residents can. For example, I have a lot of clients from Australia. For certain investments, you have to have at least $1 million before they say, okay, now you're okay to invest in these certain deals. If you're international outside of the United States, you don't have to meet those qualifications. So there's a lot of things you can actually do to take advantage, and especially in the United States, there are so many different sub-markets. There are literally hundreds of markets. There's even a few of them that are much, much better than the ones that make the news. They're the boring ones that nobody talks about on the news. Those are the ones I invest in. And I have clients like in Europe as well, where they'll literally invest in assets in the United States and get paid much higher returns than they will investing in their own country.
Chris, this has been eye-opening. I wish we had more time. Thanks for dropping by.
Yeah, absolutely. It's been a pleasure.
A big thank you to Chris Miles, the anti-financial advisor and CEO of Money Ripples. I'm Howie Lim, and this has been Money Hacks by the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.